See here, when an autoregressive model is correctly specified. Autoregressive means you understood in that question, the question that you mentioned or the content, it shows that they are, as a revised model, they are using autocorrelation. You understood this one because you are taking the lagged one, right? See this one, like this lagged one. See, this is yt and this is yt minus 1. Okay, so why are you doing like this? Reason being, initially it was showing serial correlation, okay, or autocorrelation. So because it was showing autocorrelation, you started using this lagged one as a remedy. So now it is a revised model, which is fine. Now it is properly specified.
Because I was looking for some, for checking if this is proper or not. We use t-test, right? So I was checking for that part of the question, but I did not get it. So I was like, is this they have done correctly or not to check that? That is why I was very confused.
No, they have not gone to that extent. All they have mentioned is within the given condition. Now, quite possible that in that, okay, now what you are thinking is, see, initially it was misspecified. Misspecified because it was showing autocorrelation. Now, as a remedy, you went for lagged data. So that much only they have mentioned. So that means you have revised. Okay. Now, beyond this, what you are thinking is quite possible that that revised also might have again autocorrelation. Then you have to go for further lagged one. So that means t minus 1, minus 2, like this, you have to keep on continuously going there. Okay, like for example, if you keep facing that autocorrelation, you have to go for 1 month or then 2 months, 3 months, like this, you have to keep on going further.
Okay, I was getting confused. That is why I just clicked on, I selected B. Okay, after autocorrelation, serial correlation, we have to go for lagged only, that only. So I was like, okay, let me choose B right now and ask if this is right or wrong.
Yeah. No, the story actually stops over here itself. That it is revised there. But still, if you face, then again you have to go for another one. Another, like instead of 1 month, you can check for 2 months then. Like, for example, you can say y is equal to B0 plus B1, the way they have done here. Like xt1 minus 1 plus b2 x t minus 2. This way you can go for multiple lagged data. Okay, but they have not spoken all these things. They said you have revised. Okay, so now the revised one, you show the content. So here all they said that Gran adds to the model a lagged value of the dependent variable as an independent variable. Gran refers to this model as the revised model. And the story stops there. Okay. And the question, show the question now. So question is, Gran's revised model for Canadian firm is most likely misspecified, not misspecified, and misspecified. Now, first one says misspecified as the error terms will be correlated with an independent. Now, why should the error terms be correlated now? We don't have any such proof. Correlated with the independent variable. That was never the problem, first of all. Okay. That was never the problem. Is that okay?
Yes.
Then third one, misspecified as the error terms in the revised model will be serially correlated. Why so? Why should it be serially correlated? So then it
Within
has
the
to be
lab.
not misspecified, na?
Okay.
See, lagged one maybe, may not be. We have to check that using t-test that you said. But then how can it says it will be serially correlated? Why so?
True. It can be was a
Ha,
better word.
ha. If they would have said, yeah, it can still be serially correlated, but still you cannot conclude as misspecified then. Then the C option, if C is the right answer, then it should have been that even after revising, still there are probabilities that it will be serially correlated. Then we can say yes, correct.
Okay, got it. Next, these first four questions are.
Based on joiners regression, the 95% prediction interval for stock returns on Monday is closest to. Wait. Yeah. Go to the content now. Joiner is interested in the relationship between US stocks returns and the day of the week. Okay. That means which week, which day of the week, what returns it gives. Specifically, she believes that the returns on Monday may be lower than returns during the rest of the week. Her regression equation is, okay, ST is the US stock return and DT is the dummy variable, equal to 1 if the return falls on your Monday. Okay, if the return falls on Monday, it is 1. Okay. And 0 if it occurs during the week. So if it is during the week 0, the daily data examined for the last 30 years of returns, the intercept is 0.1428 and the slope coefficient is minus 0.1194. The standard error of the slope coefficient is 0.0391. The standard error of estimate and standard error of the forecast. Okay. Okay, I'll share the screen now. Intercept is 0.1428 plus slope coefficient is minus 0.1194. Okay. So if it is 1 or 0, okay. The question is, based on joiner's regression, 95% prediction interval for stock returns on Monday is closest to. So what is the formula for that interval? Mean plus or minus Z score into standard error. Okay. So Z score will be for 95% interval 1.95 into standard error. For Monday only, no? So Monday should be okay. Just calculate this part first of all. This is the mean.
0.2622.
0.26.
22.
So 0.2622. Then standard error. Standard error is
0.0612.
the standard error of estimate, standard error of the forecast. So standard error of the estimate and standard error of the forecast. I don't know the difference. I have to see. But right now we'll just see 0.0419. Just calculate now.
Zero 0.3439.
Okay. 0.3439. You added or you subtracted?
Added.
Okay. So you minus also.
0.1804.
Okay. It's not matching, no? No, it's not matching. If we take 0.0612. Try now.
0.3815 and the other one 0.142.
Still it is not matching, right? Okay. Okay, then you just share the answer. Let's see.
The answer is only completely different.
Okay, you show.
There, this only they have got different. 0.0234.
Okay. The predicted value is calculated as the sum of the intercept and slope. So that is what we did. No? 0.1428 minus 0.11.
I think I by mistakenly added because I saved it in negative. Okay, sorry.
Okay, so this is wrong, no? This number. Check. What is it?
Zero 0.0234.
0.0234. Is this matching then, this part? So 0.0234. Now, which this standard error have they used?
0.0612.
This one only they have used. Okay, now you calculate. And Z score is 1.95.
1.96.
96, right? Z score is 1.96. Yeah.
Yeah, this answer is coming.
Yeah.
I have completely forgotten this, how to get the prediction interval. I think it was in level 1, if I'm not sure.
Also, I need to see the difference between that standard error of estimate and standard error of forecast. Standard error of estimate is for the entire model. Oh, yes. This I recollect now. Standard error of estimate is for the ANOVA table we used to do for the entire model, SEE. Remember, standard error of estimate is equal to root of MSE, mean sum of the squared error. So that is not required here. So that's a standard error of forecast they have taken. Right. Okay, is this okay now? Clear?
Yes. Sir,
remember that between this SEE and what happened?
Some like this is being expected, or
yeah, it is possible. There is nothing difficult. What is difficult in this sum?
Actually, I don't remember doing this question only.
Okay, fine. So this was there like one sum in level 1. Yeah, I didn't emphasize though. In level 2, I think we did not do anything. Okay, but it is a simple one. This is as good as it is called confidence interval. The formula for confidence interval means, now this is the one, right? Now interval means, you have a range. Interval means range. So 95% confidence interval means the formula is there is a video also I made this. I will send it to you in some time. You can watch that as well. The formula is from the mean. Okay, from the mean, left and right hand side. That's why we are doing plus and minus. Plus and minus based on Z score into standard Z score into standard error. Standard error. This is the formula. Z score into standard error. So you will get the range, both the sides, left hand side as well as right hand side, confidence interval. It can be 99% confidence interval also. It can be 90% confidence interval also. You remember we did like this for 95%, 1.96. For 99, it is 2.56. 2.56 and this is 1.65. So only this Z score is going to change.
Okay. I'll do that once. I think that is the reason they are giving quants level 1 supplies for reading in level 2.
Okay. Okay, this is clear right now? Given the ANOVA results for grants regression of the US consumer products firm, results against the S&P 500 index written, at your 5% level of significance, the best interpretation is that the coefficient of the S&P 500 variable is equal to 0, greater than 0, not equal to 0. Given the ANOVA results for grants regression of the US consumer products firm against S&P 500 index written, a 5% level of significance. Okay. I'll take the screenshot. Given the ANOVA results for grants regression of the US consumer products firm. Okay, you go to the content. This is the one. Okay. Gran is interested in how the returns for multinational corporations are related to returns of individual country markets. As you start, she regresses the returns for your large consumer products based in the US against the returns for the Standard and Poor's 500. There were 1190 weekly returns used in the regression. The analysis of variance results are presented in the following table. Sum of the squares, regression residuals total. Okay, regression. Sum of the squared regression, sum of the squared residuals. Okay. So SSR and SSE. Now the question is, given the ANOVA table results for grants regression of the US consumer products against the S&P 500 index, a 5% level of significance, the best interpretation is that the coefficient of on the S&P 500 variable. Okay, coefficient. Only this much is there, nothing beyond this, right?
No.
Below this, nothing. No? Okay.
The question starts.
No, after this, what is that? After that total? Below total, what is this one? This is another one.
Another question.
Stock.
Question
Okay,
four
okay, yeah,
is
that
on
is
this.
another. Okay, that is another one. Yeah, leave that one. Okay. The best interpretation is that the coefficient of S&P variable is equal to 0, greater than 0, and sum of the squared error, sum of the squared. Okay. Sum of the squared. You remember it was like this, the format, degree of freedom. Yes, so sum of the squared regression is 0.2688 and sum of the squared error is 1.0839. Okay, now total is total is how much? 1.3527.
Sir, they have also
3527.
given the table of T distribution. For 5%.
Okay, you just share that also.
Table of
Sure. Share that screen.
F distribution for 5%.
So degree of freedom is 1 and degree of freedom is 1. Okay. And
That number is around 1190 weekly return.
Okay, wait, show the question again. Show the question, that content. Yeah. So the content is beginning from here only. Gran is interested in how the returns.
This is the last we solved it. This one.
Uh-huh.
This is where it's
Okay. Okay. The question is, analyst of variance results are presented. There were 1190 weekly returns used in the regression. There were 1190 weekly returns. Acha, there were 1190 weekly returns. Okay. 1190 weekly returns. Yeah. So n is equal to 1190. Then, so based on this, the interpretation is that the coefficient on the S&P 500 variable is equal to 0, greater than 0, and not equal to 0. Y is equal to A plus BX. This is the coefficient. Coefficient is covariance. This is beta. Then beta is
okay. They have done F test only. If we see the answer, they have done the F test. MSR divided by MSE.
okay. MSR divided by MSE. So degree of freedom, here it will be 1, and here is n minus k minus 1, 1190 minus 1 minus 1. So that means 1190 minus 2. So 1188. So here we will get MSR. Okay, we will get MSR here. We will get MSE here. And then they have done F test. So MSR will be the same number.
This will come to
0.2688 by 1. Will give you 0.2688 again. And this one is 1.0839 divided by 1188. Just calculate this one.
0.0009.
0.0009. Then MSR by MSC is F test. F test. So MSR by MSC. MSR is 0.2688. 0.0009.
294.62.
294.62.
This is coming from.
Okay, but why have they done all this? The best interpretation of the coefficient, the question is, the best interpretation is that the coefficient of the S&P 500 variable.
And then they do the F-test graph kind of thing, and then
Okay, you show the answer. I have not understood why they have done like this. Okay.
I think I remember the concept of like F-test is used for checking if the variables are consistent or not, that they can be used or not.
Okay, I'll read this explanation. The best interpretation of the ANOVA analysis from Grant's regression is that the coefficient on the S&P 500 is not equal to 0. The F-test is calculated on the mean regression sum of MSR divided by MSC. The mean regression of square is the regression sum of the square divided by the number of estimated slope parameters. The mean squared error is the sum of squared error divided by the number of observations minus k minus 1. Okay, all these are fine. Then critical F-test is 3.84, 5% significance level and 1 degree of freedom in the numerator and more than 120 degrees of freedom in the denominator. The null hypothesis for the F-test is that the slope coefficient, in this case we have just one coefficient, are equal to 0. Given the calculated F-test, we would reject the null hypothesis and conclude that the single slope coefficient in this case is not equal to 0. Okay. Okay. So basically,
This is the
I
same concept,
understood.
the nested models and one.
Yeah. See, what they mean, see, they mean, why have they done like this? Because the question says y is equal to b0 plus b1 x1. Okay, and this is the question, whether this slope coefficient is significantly different or not. The slope, that is the question. Now I was wondering why they were doing like this. So as per the explanation, what it means is, this is the regression line. That means this line, this is the regression line. This b1, because this b1 is only the slope, no? Okay, and this part is this one, mean sum of the squared regression. Okay, divided by, or this one divided by sum of the squared error. So that means for each error, how much is the regression? So for each error, it is overall, it was coming as 3.84 as the critical value, and 294 is way ahead. And null here will be, slope is not significant. Slope is not significant. And alternative is slope is significant.
When it gets null is getting false, it's false, rejected.
Slope is significant.
So the answer
Okay.
comes not equal to 0.
So we are rejecting, and so slope is significant because this number is falling outside, right? Okay.
So the answer can be B or C, any one.
Now coming to the options. Option A says equal to 0. Option B says greater than 0. Option C says not equal to 0. No, it is greater than 0, right? B.
The answer is C, not equal to 0.
Okay, then again I have to see. Just share that one. See. we would reject the null hypothesis and conclude that single coefficient it is not equal to 0 because null and alternative will be not equal to, null will be equal to 0. Slope is not slope is equal to 0, null, that means not significant. Alternative will be slope is not equal to 0.
Okay, I understood this.
That decision rule.
So it can be lower or more, doesn't matter.
So now the point to remember here is when they say slope coefficient, so again we have to do F test only there.
I think they're just written coefficient.
Coefficient here, it is all slope coefficient only.
Ah.
Because there is only one independent variable over here. It is just about returns and the weekdays, correct? So returns is Y variable and weekdays, Monday or non-Monday, is X variable.
I think this should be same as the second question that we did.
Yeah. You try now quickly.
We'll try this. So I think I'm stuck here. Like standard errors, so there are 3 standard errors there.
Okay. Okay, you are not able to do. Okay, let me read first. Wait. Joyner has also been evaluating the relationship between US stock returns and the commercial paper, which is the 6-month commercial paper rate minus treasury bill rate and the federal funds rate. She uses monthly data and has 294 observations in the regression. The results of the regressions. Okay, fine, I'll do this. So this is the equation.
Okay, we need to only
Okay, these rates are not given only.
no, and we
Anywhere,
need to
okay.
find it for only CPP6 and not Fed fund.
Oh, okay. Just share that question. Show that question. I didn't take the screenshot. Okay, only for CPP 6 regression coefficient. A 95% confidence interval for the CPP 6 regression coefficient. Okay, okay. Um, mean plus or minus Z score into standard error. Okay. Plus or minus Z score 95% they said, so 1.96. Standard error is also there, 0.64. Okay, now the question is, what is the mean value? So mean value is missing, right? Otherwise, rest, if we get the mean value, we will get to know the answer then. So how do we know the mean value? So mean value should be even here y's value is not mentioned. Okay, yeah, this part is missing. Okay, let me see the answer then. Show.
So they have used negative 3.1.
Negative 3.1, but that is the coefficient. The results of the regression US returns 95% confidence interval for the CPP6 regression coefficient in joiners regression. Okay, correct. Because the question is not about CPP6. The question is about the regression coefficient of CPP6. You understood? The question is not about CPP6. The question is about the regression coefficient of CPP6. And what is the regression coefficient? That is minus 3.1.
So first they were asking for stock returns, because return is over there.
Now the
Now they are,
topic itself is regression coefficient. We were emphasizing on CPP6. But if you read the question carefully, it says confidence interval for the CPP6 regression coefficient. So the emphasizing word has to be regression coefficient. Regression coefficient of CPP6.
sir, can you just screen share and show me the formula once more? I'll take a screenshot of it or just write it down.
So because they said regression coefficient, it will become minus 3.1.
So in the previous question, mean was already given to us.
No, in the previous one, we calculated mean, right? We predicted y is equal to. So that's what I was trying to see this time. But the question itself is not about the mean. The question is only on the regression coefficient.
Okay, got it now. I'll do these sums once more, man. I think I'll be able to do it on my own. Because I don't know where I'll get more sums like this also now.
Mm-hmm. Okay, what is the next one?
Just a minute, I'll share screen. Uh, I have a very bad confusion with endogenous model, neoclassical model. I'm okay with the classical model. Majority of the times, whenever I choose it's a classical model, it turns out to be neoclassical, and vice versa. It's like question number 32.
Which growth model theories do comments 1 and 2 originate from? Okay, wait. Go to the content now. This is economics topic, no? Okay. So comment 1. The economy does not converge to a steady state of return, state rate of growth independent of savings. The economy does not converge to a steady state rate of growth independent of savings investment decisions. The question is, which growth model theory do comments 1 and 2 originate from? Okay, it is only about comment 1 and 2. Comment 1 says the economy does not converge to a steady state rate of growth independent of savings or investment decisions. Second one is growth in TFP, total factor production, right? TFP growth in TFP is exogenous to the model, but the steady state growth rate depends on TFP growth rate. Okay. Now the options are both comments refer to the neoclassical model. First option. Second option, both comments refers to the endogenous growth model. Third one, comment 1 refers to the endogenous growth theory, and comment 2 refers to the neoclassical model. Comment 1 refers to the endogenous growth theory. And Comment 2 refers to the neoclassical model. Comment 1 refers to the endogenous growth theory. Comment 2 refers to the neoclassical. Okay, this I have to see the book only now. Wait, I'll just open the book. Economics. Economics. Are you able to see the screen?
No.
Okay.
Yes, I can see.
So first statement is now I didn't take the screenshot. Just you share it. Yeah, okay. So the first statement, the economy does not converge to a steady state rate of growth independent of savings. Neoclassical, no? First one is, they said first one is, no, first one refers to endogenous growth. Where is it given endogenous?
It is given on the next page. After that, there is a sum kind of thing, and after that, we have endogenous growth thing.
Okay. Ah. Here it is. Unlike the neoclassical model, there is no steady state growth rate. So it says, first one says, the economy does not converge to a steady state rate of growth. So that increased investments can permanently increase the rate of growth.
First one is like there is convergence.
No steady growth rate.
But in endogenous,
No steady growth rate. Okay. No steady growth rate. Okay. No steady growth rate. Then the second part of the statement is independent of saving and investment decisions. So where is that mentioned? Independent of saving and investment decisions.
Growth comes from increased risk.
Savings or investment decisions. So that increased investment can permanently increase the rate of growth. So this connection is not there. It is independent. No steady state growth rate, so that increased investment can permanently increase the rate of growth. So that means it is not connected. This statement. It is okay now?
Yes. Okay.
Okay. This one. Second one is growth in TFP. So second one is coming from neoclassical model. Growth in TFP is exogenous to the model, but the steady state growth rate depends on TFP growth rate. Okay.
Okay, but in the
Neoclassical model. No? So
endogenous
this is
framework.
neoclassical model. Neoclassical model. Growth in exogenous. Exogenous. There is no word only.
I think no, it's
Neoclassical. This is neoclassical. Okay. Steady state growth rate depends on TFP growth rate. Steady growth rate okay. Here it says steady state growth rate for the purpose of neoclassical growth rate does not assume a constant level. Comment 2 says growth in TFP is exogenous to the model, but the steady state growth rate depends on TFP growth rate. TFP growth rate. Growth in TFP is exogenous to the model, but the steady state growth rate depends on TFP growth rate. TFP.
Yeah, I just used ChatGPT and it said that exogenous TFP is for neoclassical and endogenous TFP is for endogenous.
Mm-hmm. Okay, I'm not getting exactly where in the book it is mentioned. But yeah, you can use ChatGPT's help also then, and then you can just read more about it then. Here I'm not able to find out. Or you can properly read this all over again. Probably you will get it somewhere, because even if you don't get it, is fine, because when you read, you never know what you are reading now. Here you might get some question from this, right? Okay, but that comment I'm not able to see here. Okay, we'll just move them to the next one only now. You share the next question.
Comment 3 is most likely referring.
Okay, comment 3 is most likely referring to club convergence, absolute convergence, and conditional convergence. So comment 3 says a poor country that implements the necessary institutional reforms can converge to the income level of the wealthier nations.
I get very confused between club and conditional over here.
Okay. So these are all theories, conditional. Okay, fine. Okay. Convergence. Club means within the same group. For example, BRICS. BRICS is one club. Okay. Similarly, so this kind of groups, regions will be there, right? Absolute convergence and club convergence. Where is conditional convergence? Okay, conditional convergence here. Absolute convergence hypothesis states that less developed countries will converge to the level of per capita output of more developed countries. The neoclassical model assumes that every country has access to the same technology. The neoclassical model assumes that every country has access to the same technology. This leads to countries having the same growth rate but not the same per capita income. And as such, the neoclassical model does not imply absolute convergence. The neoclassical model supports the conditional convergence, which states that convergence in living standards will only occur for countries with the same savings rate, population growth, and production functions. So, are you able to get this one? If countries with the same savings rate, population growth, and production functions are same, then if these conditions are matching, then convergence will happen.
Okay. Okay, got it now. The difference is that the population and stuff is different, and here the financial markets or the rules and regulations should be implemented.
Yes, conditions are there.
Okay, so conditional is like only A level things are there, minimum things, and club convergence is high
Club
maximum.
means they are clearly saying we are your groups, the countries with similar institutional features such as saving rates, financial market, property rights, health and educational. Under club convergence, poorer countries that are part of the club will grow rapidly to catch up to their richer peers. Countries can join the club by making appropriate institutional changes. These countries are not part of the club. Okay.
God knows how many times I read this, but it's like when the teacher comes and tells us, "Naki, this is the way," I think that sticks to the brain more.
Because these are all something we have to learn with questions. With questions when we fall down, and then when we read, then only it will stick to the head. Otherwise, without questions, if you simply read, it will not stick to the head. Okay. Countries may be a part of the club, that is countries with similar institutional features, saving rates, financial market. So here you think like European Union club. Okay, there is one club, no? Similar features, saving rates, financial market, property rights, health, education services. European Union will be a good example. Okay.
Right.
Then here conditional convergence is, say for example, India, Bangladesh, Pakistan, because we have more or less similar kind of background or similar kind of this population growth. China, okay, this kind of, not China will be little different production, but we can say because all these are developing country, India, China, Bangladesh, this one conditional, because we are more or less the background is matching for us. And absolute one is just, it says that less developed country will automatically converge to the level of per capita output of more developed countries. There is no other condition. That's why it is absolute.
Okay. Absolute is fine.
Okay. Absolute doesn't require any condition. Conditional is like India, Pakistan, and Bangladesh, Sri Lanka. These are all more or less similar kind of countries because their background is all matching. Okay, same, all these are developing countries. Okay, and club convergences, you think about European Union. That means your savings rate, financial market, they have European, I mean, central bank, all currency, same currencies. Okay. Is it fine now? Okay. Okay, then next one. How many of when these statements are correct? Okay. Show the content. Statement. Okay. Globalization of capital market has increased the risk of financial contagion. Yeah, that is correct only. Second one, prospectively, regulators often focus only on the direct cost arising out of your regulation while conducting their cost benefit analysis. No, regulators, they prospectively, regulators often focus only on the direct cost arising out of your regulation while conducting their cost benefit. No, they do indirect cost also. So it should be only one. C is correct. Check.
This is also right.
First one is correct one. First one is very clearly correct.
Their answer, both statements are correct. And after that, I googled it. Now they are saying that only one statement is correct, is right. Wherever I see AI answer, it comes as C only.
Only one is okay. Let me read that statement to your answer explanation. In assessing regulatory burden, regulators need to evaluate both the direct and the indirect cost. Yeah, they need to. So we are assuming they are doing it. indirect cost includes the cost of unintended consequences, because indirect costs are difficult to assess on it. They are discovered only on your retrospective. Okay, because indirect costs are difficult to assess on a prospective basis, they are often only discovered only on a retrospective basis. Prospectively, regulators therefore only consider the direct cost. Now, this is now it depends how we are interpreting, how we are understanding. So the content is that much only, is it? Have they mentioned anything before that statement? Before that, nothing is there.
This is for the another sum, the another question. That's it.
Okay. Okay. So that's why now that's it. Then it is because here they are saying that regulators only consider the direct cost. No, they consider indirect also, but when they consider indirect, to an extent they will be able to predict. To an extent they will not be able to predict. When they will not be able to predict, then that is fine. But they attempt. So that is why it should be only one should be correct. Okay, because if we select both, then we are actually saying that they never care about what will be the indirect cost, and that is a wrong statement. So I can say like that means this what they have mentioned is only wrong. Okay, so you go with what we have decided now, that only the first statement is right, because otherwise it's like no regulator is trying to find out the indirect cost, and that will be a wrong statement. To say that no regulator is trying to find out the indirect cost. Williams statement 2 is best described as correct. Williams statement 2 is best described as correct. Correct and incorrect about comparing current forward rates to. Okay, I'll take this screenshot first. Show the content now.
Okay, now I understood this question.
Active bond portfolio management entails comparing our expected future spot rates to current forward rates. If our expected future spot rate applicable for a bond is greater than the corresponding current forward rate, we would consider that the bond be overvalued. So that means, in short, they are saying interest rate is going up. If interest rate is going up, then the bond price will come down. Okay, so in future, the bond price is supposed to come down. So that's why it is overvalued. Yeah.
I would consider this as a mistake. Now again, those 8 questions I said are completely not getting those answers. The next remaining 4. Sorry.
Which question now?
I messaged you, right? The 8 questions I'm not getting completely. This was the 4 we already did, the above ones. First row. Now the remaining 4 are these.
Okay. Now this question 45.
Yes.
Okay. Yeah, show the content now. Based on information in Exhibit 1, Regiono pre and post acquisition balance sheet, the book value of Ferrer's net asset is closest to. Okay.
We purchased 80%.
Pre and post acquisition balance sheet, the book value of Ferrer's net assets based on Exhibit 1. So we have to calculate net assets, book value of net assets.
So net assets means equity only, right?
Yeah, equity only.
I need an assumption over here because the numbers are very high and low, right? So it was definitely not 8,300. It was lower than. So I choose A, and that was right. How did I get it or it? I don't know.
The book value of Ferrer's net assets. Ferrer's means who? So I have to read from the top, I think. Book value. Oh, I'll just read to be on the safer side. Should I read all? Because they have given two column, right? Gino has hundreds of stores in 42 states across the United States. Most of the storage are large footprint. Okay. The average Ferret store is well below. Okay. See that above that exhibit, the paragraph, Winchester is interested in how potential acquisition would affect Ferrer's financial statement. That means after, and asks an intent to prepare a consolidated balance sheet. This balance sheet, along with the relevant notes, is shown in Exhibit 1. Okay, Regino follows US GAAP in preparing their financial statement. Okay, so we'll do post only and then see. So current asset is given, total asset is given. Now again, scroll down. And so total assets, current liability, total liability. Total assets. Cash receivable, current. Okay, current asset is 60,200. Okay, then total asset is 210,349. And okay, first I'll just take the screenshot. Can you just show all this in one single page? Yeah, enough. Okay. Okay. Yeah. No, it is fine now. So total asset is 210. 349. So 210,349.
So are you sharing a screen or anything?
Okay, let me write, and I'm not writing, but I'll
No,
share.
it's okay. It's okay.
Yeah,
I thought you were writing.
I'll just still write better only. So current asset is 6,200. Total asset is 210,349. 210,349. And then current liability is 73,286. And then equities and liabilities. Current liabilities. So remaining is long-term debt. Okay. So debt is 51,331. Total current long-term debt. Okay. And then common stock. Okay. So now you just add 23,095, which is common stock, then 49,000, then retained earning 11,966, then non-controlling interest 1,671. Calculate all this.
85,732.
Okay, so this becomes equity. Okay, now coming to question, the book value of Ferrous net assets 85,732. 85,732 is not matching there. Okay, but if we do in the same way, then for pre, it will be 23,095. No, 1 second. Did I take pre or post? No, I took pre by mistake. Right. It should be 23,095, 49,000. No, I did properly only. Okay, so then I'll take pre. 23,97095, then 49,000. Then 11,966. You add up these three, but there is hardly any gap.
84067. So that's right, 1671. I saw the answer. It comes same.
What is the answer?
1671. Net.
So where did we get 1671?
When
This
I
one?
previously when we calculated the assets.
We got 85,732, no?
Yes, and right now we got 84,061.
Okay. Net. Acha. That's what they mean by net. 84, how much?
061.
And what is the difference?
1671.
Okay, and they are mentioning that as, but that is also not matching, right?
No, that this is for 80%, and we need to find it for 100%.
Oh, 1671, 80% into, so 1671 by 0.8 into 1.
So they're dividing it by 0.2.
Dividing it by
0.2. They're finding the non-controlling interest.
0. What did you say?
0.2.
1671 divided by 0.4.
2.
And into 1, is it?
Huh.
How much is this coming to?
Eight three three five. And the answer is 8300. Very confusing.
Okay, you just share the answer. Let me see. The question is based on information in Exhibit 1, Regional pre and post acquisition balance sheet. The book value of Ferrer's net asset is closest to 8,300 million. Explanation: the non-controlling interest in the group balance sheet has been prepared using the partial goodwill method, assuming no fair value adjustments. Okay, this we did not factor in. This means that the NCI is 20% of the book value of Ferrer's net assets. Hence, the book value of the assets is 1671 divided by 0.2, which comes to 8355 million. Okay. The non-controlling interest in the group balance sheet has been prepared using the partial non-controlling interest in the group balance sheet has been prepared using the partial goodwill method. The non-controlling interest in the group balance sheet has been prepared using the partial goodwill method, assuming no fair value adjustments. This means that the NCI is 20% of the book value using the partial goodwill. Non-controlling interest is 20% of the book value. Okay, so 1671 we have got, that is 20%. Okay, see, you go to the content.
I think below it is written that there
It is prepared in acquisition partial goodwill method. So this is an important point. This is the point actually. So because this is partial goodwill method, so the difference, that means the change in the book value from pre to post, it is showing the difference after acquisitions, but that acquisition change is representing 20% only. Okay, and the question is the book value of Ferrer's net asset is closest to. So the book value of Ferrer's net assets.
okay.
So Ferrer is the acquirer
No,
or
he is the acquiree.
acquiree, correct?
Yes, we are taking the this guy's.
Okay, understood.
Okay,
So
I also.
Ferrer is the acquiree, correct? Then okay. Understood? Because Ferrer has taken, so Ferrer is the acquiree, right? So Regino is the acquirer, I think. Regino, they have taken 20%. So it is representing 20. So that we are converting into 100% to find out Ferrer's.
Yes. Regino has taken 80% and 20% is remaining in the balance sheet of Ferrers, right? Right. That is
That is in the
why we
pure
are
cost.
using this guy, this company's full app. I was doing, minusing this from this and trying to find out what is the Ferrer's previous balance sheet.
Acha.
Okay, this never linked to me that I can solve it.
This even I'm not expecting you to know. These are all some exceptions, but yeah, now we know that okay, this way also we have to think. So these are all some other ad hoc kind of information.
By any chance it comes, then I know how to handle it at least.
That's why I see these are all ad hoc information. There might be something which is not at all connected only, some other altogether a different one. Such things you can ignore. But there will be some ad hoc kind of thing you can quickly note down all those. Which one now? This one? 46?
I was just writing this down. 46.
Okay, using information in Exhibit 1. Wait, I'll take the screenshot. Wait. Using information in Exhibit 1, Regino pre and post acquisition balance sheet, and after making adjustments on adjustment 1 only, and after making adjustment 1 only, the consolidated equity plus liability is most likely to be after making adjustment 1 only. Adjustment 1 only means the consolidated equities plus liabilities is most likely to be higher by less than 50 million, higher by more than 50 million, unaffected by the change in investments. Investment 1. So why do they say 1? So you go to the content.
There are adjustments.
Okay, in adjustment 1. Adjustment. Okay, this is adjustment 1. Winchester does not believe that the method used to calculate goodwill is in line with current accounting standards and intends to restate post balance sheet using a method consistent with US GAAP. US GAAP is partial, right? US GAAP is partial.
No, US GAAP is full. IFRS is partial.
Is it? Are you sure?
Yes.
Sure? Okay. Because I feel the other way. Wait, let me just check that one. Wait. FSA, no? FSA. Partial goodwill only allowed under IFRS. Full goodwill required under US GAAP. Okay, under US GAAP, full goodwill. Okay, correct. US GAAP full goodwill. So that means we are going to focus on full goodwill. So if we focus on full goodwill, the amount will be higher.
Higher.
So if the amount is higher, okay, so that means the amount is supposed to be higher. Yeah, so in that case, the consolidated equity plus adjustment is most likely to be, then it should be higher by, okay, it will be higher, but you never know still 50 million. So it looks like it should be B now. But then that we have to again, it looks like it is B. Okay, we'll check. If not, then we have to refer the answer directly now then. Yeah. Because based the way they have framed the question, it has to be B then. Because see, in short, the equity will go up, and when equity is going up, then because full goodwill means what? Goodwill will go up. So when goodwill is going up, that means right hand side balance sheet is going up. Then the left hand side equity also has to go up. So then it will be higher. So EC we can eliminate. Okay, so it is between A and B. So between A and B, higher by more than 50.
I think we are
Acha, here all explanation, yeah, here all calculation is given here.
calculation is done. Because maybe it can go below 50 also. The difference. All this happens is good.
You are able to understand that answer? Now you are checking which adjustment 2 now.
No, I'm checking that how did they get the goodwill? Because 80% of this is only 14,640.
But why are you checking adjustment 2? Is it adjustment 2?
No, they are giving this is just estimated. Okay, they are giving the fair value of Ferrar's P period. So with that we can find out the goodwill. Other than that, how do I find it?
Okay, goodwill you are asking how to find out. So goodwill is what? Fair value of net identifiable assets, right? Fair value of net identifiable assets. That full goodwill, no? So net identifiable assets we have to find out. What are you searching? We have to go to that exhibit 1, and here only you will get it, right?
But these will be only book values. Okay,
So
I'll do this then.
book value, but you have to see above that one or below that one if they have changed the valuation of any assets. If not, then we have to take book value only.
Okay, I'll do this question.
If fair value is not given, we'll take the book value as the fair value.
So
47. Using the information in Exhibit 1, Reggiano pre and post acquisition balance sheet and accounting for adjustments 2 only. The post, that is consolidated debt to equity ratio using Winchester's methodology, is most likely to be higher than the current calculated value, lower than the currently calculated value, unaffected by adjustment 2. Okay, wait. Okay. So now you should go to the content. Using the information. So, okay, show the adjustment 2 first of all. Yeah. Winchester believes that Ferrer's PPE, property, plant and equipment, has a fair value that is higher than the reported book value. Winchester estimates that the fair value of the Ferrer's PPE is approximately 18,300. This value still results in a positive goodwill figure. Okay, Winchester is interested in the impact after these adjustments would have on the consolidated debt to equity ratio. Okay, so this way, if fair value is going up, the goodwill will go up. If goodwill is going up, equities will go up. If equity is going up, then debt to equity ratio will come down. So it will be B. Equity will go up, so it will be B. It is A they mentioned. Okay, then let me read. How A. Ferrer's PP at book value is so and so. The fair value is okay. In the consolidated balance sheet, this would increase PP and non-controlling interest, which is 20% into fair value. Okay, the goodwill will still be positive. If goodwill were negative, it would be considered a bargain purchase and the resulting gain would be reported in the income statement. Okay, since Winchester deems non-controlling interest as part of debt, the value of debt would increase. Value of debt, how value of debt is increasing? Is it, acha, they are acquiring.
Oh,
Is
okay.
it they are acquiring?
This line.
Post non-controlling, reclassifying the non-controlling interest as debt rather than equity. Okay, that is the point. Then they are post debt to equity ratio after classifying the non-controlling interest as debt. So if non-controlling interest is classified as debt and okay, and equity. So equity is also going up and debt is also going up. And because, see, in this case, equity will slightly come down and debt will go up, na? Because debt is going up, because from equity only you are shifting that to debt. From equity, you are shifting that to debt. So debt is going up highly. Okay, so equity is coming down, denominator is coming down, numerator is going up. So then higher than the current calculated value. Yeah.
Sir, if you are tired now, we can continue this tomorrow. It's already 11:30.
Okay, fine. Okay. If you are feeling sleepy, you sleep now. We can
I
continue.
am fine with it.
Okay, then we can continue now.
Okay.
How many more questions would be there?
5, 6.
Okay, we'll continue.
So this one.
Using the information in Exhibit 1, again, Reggiano pre and post acquisition balance sheet and accounting for adjustments 3 only, the recalculated post total current assets would be closest to accounting for adjustments 3. Okay, wait. Show the content. Adjustment 3. Winchester has noted that the remaining 20% of equity will be retained by the family of the original founder of Ferrers He believes the family members will have significant input into the everyday operations of Ferrers even after the transaction, and hence does not feel confident that Reggiano will have control. Winchester intends to prepare a post-balance sheet with no fair value adjustments, but using an accounting method consistent with Reggiano. Okay. Winchester has noted that the remaining 20% of equity will be retained by the family of the original founder of, whereas he believes the family member will have significant input. Will have significant input into the everyday operations of Ferrers. He believes the family members will have significant input into the everyday operations.
That will go from acquisition to equity
He believes the
method.
family members will have significant input into the everyday operation. That means this shows investments in associate.
Equity method.
Whereas even after the transaction, and hence does not feel confident that Regino will have control. Okay. That means this is investment in associate. Winchester intends to prepare a post balance sheet with no fair value adjustments. Okay, no fair value adjustments, but using an accounting method consistent with Reggiano's influence but not control over fair. That means this is clearly equity method, but we will ignore the fair value. That means no depreciation is also needed. Normally we do depreciation then if we take fair value.
Huh.
Okay. So now,
So we'll still take depreciation, right?
no, because you have not taken extra value, right? This Ferrer is the acquirer, correct?
Acquiree.
Okay, acquiring. He believes the family members will have significant input in the everyday operations.
80% is with
Winchester,
Reggiano.
Acha, Winchester.
20% is with Winchester, the original founder of Ferrari. Winchester is
Okay,
the
Winchester.
analyst.
Winchester is the analyst. Okay, as noted that the remaining 20% of the equity will be retained by the family of the original founder of Ferrari. He believes the family members will have significant input into the everyday operations of Ferris even after the transaction, and hence does not feel confident that Reggiano will have control. Okay, right. Winchester intends to prepare a balance sheet with no fair value adjustment, but using an accounting method consistent with Reggiano having influence but not control over Ferris. Reggiano. But Reggiano, the question is about Reggiano. So Reggiano is the investor.
80% investor.
80% investor. So now we have to calculate. So that means we are focusing on investor only. So we don't have to take depreciation. We don't have to take depreciation, because that's why it says that ignore no fair value adjustments. The fair value adjustment is only depreciation. See, because otherwise you try to recollect what is the format. The format is, you will mention first of all equity method. So equity method means what? Investments in associate, first one. After that, what will you do? After that, you will take the proportional profit. After that, you will reduce. You will reduce depreciation, correct? You will reduce depreciation. Then after that, you will reduce interest. You will reduce interest. You will reduce interest, and you will add that, not interest, dividend,
Dividend.
and you will add that dividend to the cash.
Cash.
Okay,
So
so here
this,
depreciation will not come. Only you will reduce dividends. Yeah, only proportional profit you will add, and you will reduce dividend.
right. Okay. Here I've written that the depreciation is not done. Right. Okay.
Okay, should we calculate it now?
Yes.
Okay, then you go to the again the content. This is not the content. We have seen only adjustments 3. Now the we have to know the profits. Only we have to take profits. Here we should get some information. Where is it mentioned that investments?
This is the acquisition method. Retained by cash. That is just money that is gone.
But where have they mentioned? It should be other current assets. Other, no, but other, not other. Should it be other current assets? Current assets and no, not other. It should be non-current assets. But that we cannot see here. No, the question is the recalculated post. But see, what is the question here? The question says 48th question only, right? The recalculated post current assets would be.
Okay, I understood. The money that they paid, 7,000, we need to maybe add that
We have to
over.
minus that. That cash will go away. Yeah, minus we have to do. And that is why that cash has come down. But the question, the topic is the recalculated post total current assets would be closest to total current assets. But they have given already. 2968 is given.
I think we just need to add 7,000. This whole thing. Yeah. Calculate it.
See, the question says recalculated post total current assets would be closest to. Okay. So total, okay, it is total current assets. It is not only cash, total current assets. So here they have shown as 60,200 and 58,050. So recalculated post total current assets would be closest to.
Minus, you are right. Minus we have to do from this. We're getting 51,000 profit. The answer is that.
Yeah.
Yes, I get it. This is pre, that means we are still not acquired. After
Yes.
acquiring equity method, we will reduce cash
Huh.
and increase in investment in associate. So our current
So that
assets
will go out of current
decrease.
assets. Then.
Will come out of current assets.
Yeah.
Okay. Okay. think these are the most difficult kind of questions for me.
Mm-hmm.
These should be mostly theory now. The 53rd one.
Okay. To counter a declining growth rate, IBS could least appropriately acquire faster growing companies, divest the slowest growing business segment, undertake a cost restructuring to counter declining growth rates.
There is no
Least likely
content also.
acquire to counter declining growth rates, least likely acquire. So most likely they can acquire faster growing companies, or most likely to counter declining growth rates and divest the slowest growing business segment, undertake a cost restructuring. Undertake a cost restructuring seems to be the one least appropriate. That
I think
is
that is
not
right.
something will work out. Yeah.
Hmm.
Yeah. To
I
count.
chose C only. Okay. What I thought was if they restructure it properly, that
Hmm.
means they'll reduce their costs and everything. It'll be a permanently, your profits will increase in that way.
A restructuring is cost restructuring is unlikely to counter declining growth rates. Yeah, because see, if you take the first one, faster growing company, so that means something positive is being added to the company. So overall growth will be positive. Okay. Then second one is divest the slowest growing. So the negative part you are removing, throwing it away, which is good for the company. Undertaking a cost restructuring means what? The problems are out of all this. See, out of these three, you have to select one. So undertake a cost restructuring means you are when you see undertaking a cost restructuring means uh, you are changing the financing positions of the company, but then the business is having the same problem whatever it was having before.
That is what I thought with A. It is like hiding your slow growing company by acquiring the fast one. I felt it was cheating. So that is why I did not. I chose C. As,
Okay, okay.
uh,
Mhm.
so this question.
Okay. Mayer's recommendation to repurchase super transistors stock would most accurately uh, be described as uh, Mayer's recommendation to repurchase super transistors. Mayer's recommendation to repurchase super transistor stock would most accurately be described as a dividend recapitalization, stock recapitalization, or a leveraged buyout.
I got
Recommendation to
the answer
purchase
now.
supercomputer stock would most accurately be described as. Okay, we have to see the content.
Actually, there's no content.
Would most accurately be described as.
It says it is
We,
that way.
Acha, if there is no content, okay, let me see the options. One is dividend recapitalization, stock recapitalization, and leveraged buyout. You are repurchasing super transistor stock.
I just wanted to ask what is stock recapitalization? They are saying it is not defined in the curriculum, but is there
Okay.
actually anything called as stock recapitalization?
Stock recapitalization is not defined in the curriculum. Yeah. Okay, they themselves have said not defined. Stock recapitalization means bringing in more equity only. Okay. First one is dividend recapitalization is a balance sheet restructuring that increases leverage by using borrowed funds to repurchase company stock. Okay, so that is dividend recapitalization. That means you are financing the dividends by borrowing. Stock recapitalization is you are financing stocks. That means you are issuing equities. Okay. Here, Mayer's recommendation to purchase super transistors stock would most accurately be described as stock recapitalization. Okay. So why not stock and recommendation to repurchase super transistors stock? Repurchase super transistor stock. Can you understand balance sheet restructuring that increases
I
leverage
understood
by
a
using
meaning of
borrowed
it.
funds to repurchase company stock? No, there has to be content for this question. It is not a standalone question.
It's actually just this much. There's nothing more.
Not given. Wait. Super Transistor is a rapidly growing company that has plowed back all profits to finance its growth. The company has never issued debt in the capital market, and its current borrowing is a small bank loan to finance the company's receivables. Bill Mayer, ST, that means Super Transistor CFO, believes that the company's capital structure is suboptimal and recommends that the board approves a sale of 5% 20-year senior unsecured debentures to finance an open market purchase of the company. So here mentioned separately ST, that means Super Transistors wants to acquire Gemini, a small software company, for cash. Okay. So here this is the content.
But the content here says repurchase of super transistor.
Ah,
Their own stock. Their
yeah. And this guy Mayer is the CFO. So they are repurchasing their own company shares. And that is called dividend recapitalization because they are borrowing. They are increasing the leverage. So that means they are financing the dividends, in short.
okay.
They are
So
financing the
that
dividend.
means this is not dividend, no? The dividend recapitalization.
They are financing the dividends. They are borrowing, and with that, dividend. Okay, why it is dividend recapitalization? Okay,
Dividend
is a balance sheet
recapitalization.
restructuring that increases leverage by using borrowed funds to repurchase company stock. Okay, dividend. Um, okay,
So you
dividend
think that they are not paying
recapitalization.
dividend, rather they are
Repurchasing would most
repurchasing.
accurately be described as dividend recapitalization. So ideally, you should pay dividends. Instead of dividends, you are borrowing and then you are repurchasing. When you are repurchasing, um, you will have less shares. When you will have less shares, then dividend recapitalization.
Okay,
So
dividend
instead of
recapitalization means borrowing debt and giving dividend, special dividend. So it does not mean they are repurchasing.
oh, okay, you show the content again. Show the content. Company's capital structure is suboptimal and recommends the board approve the sale of 5% 20-year unsecured debentures to finance open market. Uh, where are they talking about dividends here or repurchasing here in this paragraph? Here, open market purchase of the company shares. So they are talking only about repurchase. Where are they talking about debenture dividends? So dividend recapitalization, as per the explanation, dividend recapitalization is a balance sheet restructuring that increases leverage by using borrowed funds to repurchase company stock.
That is complete opposite what it is written in the book.
Yeah, dividend recapitalization. Okay, let me just check quickly in Google. Dividend recapitalization. Recapitalization is a financial strategy where a company takes on new debt, such as issuing bonds on borrowing, to pay a large one-time special dividend to its owners, typically private equity firm. It allows investors to recover their initial investments. Yeah, but it doesn't speak about repurchase. So there is something wrong here.
Whereas in stock capitalization, it talks about repurchase.
Would most likely be described as leverage by borrowing to repurchase stock. Yeah, so this is a misleading. Okay, so there's, I will just mark this and try to search, but I think this seems to be a misleading, wrong question. I think so, because I just now I checked in Google the meaning. It is not giving any idea. Okay, but I will still check again. Okay, this seems to be a misleading one. Unfair question, I guess. We'll move to the next one.
So
This one, 86. Okay. Does Brevo's reliance on research from Analytics Inc. and or its relationship with Sequoia violate any CFA standards? This is ethics. Okay. They are saying only their, okay, you go to the theory now, the content.
these two paragraphs.
Okay. Brevo subscribes to research from Analytics Inc. to help Brevo track appropriate level of credit spread for corporate bonds purchased for client accounts. Brevo subscribes to research from Analytics Inc. to help Brevo track appropriate level of credit spread for corporate bond purchase for client accounts. Okay. Okay. Goldun has determined that the research from Analytics is very thorough. However, Goldun has not disclosed to clients that he relies on his on this information. Based on this research, Goldun prepares a list of bonds that offer attractive yields and distributes the list to all Brevo portfolio managers. Okay, and Brevo has a long-standing relationship with Sequoia, a bond trading firm. If Sequoia makes a market in a specific bond, Sequoia will accept a Brevo trade for below market commission. Additionally, any Brevo portfolio manager that generates more than 10 million in trades with Sequoia is treated by Sequoia at an all expense paid trip to the prestigious annual investors roundtable conference. Okay. So now the question, okay, I'll take the screenshot. Does Brevo's reliance on research from Analytics Inc. and or its relationship with Sequoia violate any CFA Institute standards? Only the reliance on analysis research is in compliance with the standards. Okay. Bro, full user engineers more than 10. Goldun has determined that the research from analytics is very thorough. Okay. Okay, you go to the question now. Does Bravo's reliance on research from Analytics Inc. and or its relationship with Sequoia violate any CFA Institute standards? Neither the reliance on analytics research nor the relationship with Sequoia is in compliance with the standards. Okay. Neither the reliance on analytics research nor the relationship with Sequoia is in compliance with the standards. Okay. Second one is only the reliance on analytics research is in compliance with the standards. Third one is the reliance on analytics research and relationship with Sequoia is in compliance. So third one, they are saying both are fine. First one says both are wrong. Second one says only the reliance on analytics research is in compliance. That means that Sequoia's relationship is wrong. Okay. So this we have to take it as they mention. See the explanation. Members can rely on third-party research as long as such research is sound and has reasonable basis. So in the content, they mentioned that he has determined. If you see the content, there is one word there. Golden has determined that the research from analytics is very thorough. He has determined means he is trusting it enough. That means he has some experience or he has gone through in the past, so he is trusting that. Okay.
The thing is that in previous questions, if they were not open about what things they are using to research and stuff, it should not be allowed, right? Ethically, that is wrong.
No. See, Golden. Okay, so there. Okay, now in the content it says Golden has not disclosed to clients that he relies on this information. That's what you are saying, right? Now, see, imagine you are running a company. Now, how you are doing what you are doing research, you don't have to disclose everything to the client. Okay, you don't have to disclose everything to the client. You don't have to tell them all their sources as such, because that is not what they are expecting from you. What they are expecting from you is a good research. Whatever you are informing them, that should happen. Not like each and every part of it. Like, for example, imagine you are working in a company. Now in a company, people will come, people will go, hiring, firing will keep happening. The client need not know all those things, no?
True. I was very
Then the second,
why are they, if they are writing that they're not telling that to the
this is fine. The second one is Sequoia relationship. Sequoia here, it says Sequoia will accept a Bravo trade for below market commission. Additionally, any Bravo portfolio manager that generates more than 10 million in trades with Sequoia is treated by Sequoia to an all expense paid trip. That means it is motivating them or influencing them to do trades for that paid trip.
The
which is
independence is
finance.
also violated.
Huh.
Violated.
Huh. So that is the point there, because that is motivating you to increase the transaction amount for that paid trip.
Okay. And if this analytical research, other than that, it would have been a model that they're using, then the answer would change completely because then the model has to be uh, conveyed to the client that this is the way we are doing it.
Which model? Not
Any
understood.
model they are using.
No, no model you have to convey to the client. Say for example, now so many research report comes up. ICICI Securities will say you should buy Reliance. Okay, now they will not tell you every detail, only some detail. What they will tell you is what they are expecting from the stock. They will just talk about the company. They will not, tell you all details about how they have done.
Okay.
They will just talk about the company. That company's P ratio is this, company expects this much profit, this much sales, this much, everything about the company, not like how they have done. That will be very rarely they will mention that we have taken last 5 years growth, that much. Not like every detail.
Okay.
Which system they used, all that thing they are not going to mention. Or regressive, if they say we used let's say multilinear regression. Now who understands and who requires to know multilinear regression there? People are interested to know Reliance company, not like which regressions the ICICI Security used to come up with growth conclusion.
Okay, I understand this.
Okay.
Sir, out of box question, but where do you read company reports and stuff? Have you subscribed to something or something?
I have not subscribed to anything as such, but everything is available only online. Say, for example, uh, most of the company reports, but then certain reports which are like highly valuable you may not get, but otherwise most of the reports you can get. Even if you go to screener also, say for example, if I say Hindustan Unilever. Um, or research report only you are asking, right?
Research.
Research report from Motilal Oswal. See here. We have to give these details then. Okay, but if you don't want to do that also, then we can directly come here, re-download research report of let's say Nestle India. Or see this one here. Or even if you ask ChatGPT and Cloud also, they will pull up from the this Google, and then they will give it to you. Okay. See, this is a research report. So this is for which year? You may not get the latest one. Yeah, this is 2022. You may not get the latest one because those all will be paid one. That is little difficult. That also, if you keep searching somewhere, you will get. Okay. But the format, all those things, what they are mentioning, that idea you will get.
Okay, sir. Thank you.
Yeah. Okay. Just you check like this, you should get. Okay. If you don't get, you tell me. I can search and tell you. Okay.
Okay, I'll try to find it more.
In ChatGPT and cloud, you search, you will easily get. You just give the prompt that you want to whatever company, or give me 5-6 companies research report, latest research report, which are freely available in Google and conducted by brokerage firms. So mention like this kind of prompt, research by brokerage firm, you will get it. Fine.
Okay.
Okay.
Thank you, sir.
Okay. Then we'll stop now here. Okay. Bye.